Yeah, so good morning. I can see almost everyone on board. I had some small challenges logging in, but we're okay now. So today we are starting on group accounts, of which everyone has the handouts. I believe so. Everyone has the handout. So group accounts we did in section 3. You are all aware. So we're just going to small introduction, then we see what happens. So let's go to the introduction to group accounting. And in the introduction, we are going with the notes as we discuss. So kindly open your handouts. Open the handouts. So group accounting, we are going through the notes. I hope everyone has the notes, everyone except none. I'm just wondering, Jay, that she hapa or so Jay the Jen, I'm just confirming. Is it that not Jen? Jacinta or Jacinta. So group accounting, it is an act of presenting financial statements of different entities as if they belong under one economic entity. The main objective of business combination is to expand the economies of scale and to increase the market share. You remember the story of Ilara Brookside and Akinasui, which one? There was that business combination where I think all these mill companies were being acquired by Brookside. If you check the main motive behind those acquisitions, the main objective was to increase the economies of scale, like the market share and the rest. So during accounting, once an entity has acquired another entity, you are required to present one financial statement, bringing the books of the acquirer and the acquirees under one reporting. So if it is profit account, you will collect the revenue of the main acquirer and the acquiree companies, then you present one profit account and even one statement of financial position. By so doing, you are doing what is called consolidation. Key terms. So we have key terms down there. Key term number 1, parent company or holding company. It is an entity which obtains the controlling interest in one or more investee companies, i.e., it is the acquirer company. So the entity which acquires shareholdings in other companies within the group, then that is called the parent company. So parent company, also known as the holding company. During computations, I'll be using this abbreviation for the parent company. I'll be using that abbreviation for parent company. So get used to that. Any moment we use HCO, HCO will stand for holding company, which is the parent company. Number 2, subsidiary. It is an investee. Investee is now the company which has been acquired. It is an investee company in which the parent company controls more than 1/2 of the shareholdings. That is 51% and above. So in the group, the entity in which the parent will be having this shareholding between that range, then in the group, that entity shall be called subsidiary company for consolidation purposes. Down there, identification of subsidiaries. So how do you identify a subsidiary? One way of identifying a subsidiary is through the use of a percentage. When the parent has 51 to 100% shareholdings in another entity, then that entity is called a subsidiary. So one way of identifying a subsidiary is by checking the percentage of shareholdings in that entity. However, subsidiary can be identified through other ways, and which tends to be very important for us. So let's check. Control, you know, control is presumed to exist when you have 51% and above. That is when you have control. So control is presumed when the parent acquires more than half of the voting rights of the entity, even when more than 1/2 of the voting rights is not acquired. Please underline the word not. The word not there is very important. Underline the word not. Even when more than 1/2 of the voting rights is not acquired, control may be evidenced by the power. One. So this one has been the latest. Now it is good when I tell you, it has been the latest trend or custom. You know, for you to consolidate for a company, that company must be a subsidiary, meaning you must have more than 1/2 of the shareholdings. However, there are some instances where you can consolidate for a subsidiary even if you do not have this percentage. And nowadays I've seen for like 2 sittings, I've seen customers are really into that. And please listen to that once more. For you to combine the books of the parent and the subsidiary together, let me not say subsidiary, the books of the parent and another investee company together, meaning consolidation, the parent must have more than 1/2 of the voting rights. So not voting rights, of the shareholdings. That is 51% to 100. But there are some instances when we can be allowed to treat an investee as a subsidiary, even if the parent does not have more than 1/2 of their shareholdings. So that is what we are being told, that even when more than 1/2 of the voting rights is not acquired, control may be evidenced by power, number one, over more than 1/2 of the voting rights by virtue of agreement with other investee. So if the parent may have even 40% shareholdings in that entity, but the parents, they have agreed that the parent will have more voting. It may be the board of directors or mostly the board of directors. So if the members of the parent are having more voting rights than the investee, then the parent will consolidate for that company because they are the majority decision makers. So the parent may fail to have more than 51, but if the parent has an agreement with the investee company that they will be having the majority of votes, then you will consolidate for that entity. Number two, to govern the financial and operating policies of the entity under statute or agreement. Yes, so if they have an agreement that the parent is the one who will be governing majority of the financial and operating policies, they will consolidate. Three, to appoint or remove the majority of members of the board of directors. So if parent has been given the power to nominate or to remove majority of the board members, still parent will be allowed to consolidate. So in that case, we don't check the percentage at all. We don't check the percentage they have. Then to cast the majority of votes at a meeting of the board of directors, that is more or less the same with the first one. So I want you to know those 4 points keenly. You know, even if you have 50% of the shareholdings, you are not supposed to consolidate for that entity. You only consolidate when you have control. Control exists when you have this percentage, 51. But even if you have 50, but you are the one who can appoint majority of the board members, you can remove the board members, you can govern the financial and operating policies, then the parent will be allowed to consolidate. Check for me something small there. Something small is your past papers. So get out your past papers. I want you to check something small. I want you to check something small before we decide to proceed. Before we decide to proceed. So I want you, we are just reading. I want us, Brian Kidoga, check for me December 2022. I want to read something there. December 2022. That question 3, but I'm going to tell you what we are reading. We are not reading the entire thing, and there's just a small point I want us to check, then we proceed. Meanwhile, Brian, what is the issue? The computer yes, with Brian, that is possible. So that's what we are explaining. That is it. You can get that scenario, even not 49, even 30. Even 30%, provided those things we have said exist. Which page, please, for this? Somebody was gotten? Which page? Which page is that? Page number 15. So check page 15. In that question 3, you know, I must prepare you, Mapema. In that question 3, the one for H, S, and L, I want you to check additional information number 2. I want you to check additional information number 2. Additional information number 2. I believe you are there, and you allow me to read. They say, M Limited is the main competitor of H, and on 1st May, M Limited and H Limited each acquired 50% of 200 million ordinary shares, or shillings 10 each in L. Each acquired 50%. When you acquire 50%, you don't have control. In fact, you're not supposed to consolidate for that entity. That is called joint arrangement, the joint ventures. So you're not supposed to consolidate if it is 50%. 50%, nobody claims control. You don't have control, I don't have control. Nobody should consolidate for that entity. You wait for profits is what you take equally. So M and H are having 50% shareholdings. Fine. The consideration paid by H consisted of shillings 15 per share, and also a 1-for-2 share exchange, where the market price of H shares was shillings 20. M also paid shillings 15 per share for interest, but did not issue any shares to the owners of L. The ordinary shares of L have 1 voting right each. So my main concern here, the next paragraph. Upon the acquisition, H Limited had a contractual right. H Limited had a contractual right to appoint 60% of the board of L Limited, with the remaining 40% appointed by M Limited. So up to that stage, you know, H and M are co-venturers. Each is having 50% in that L. Everybody has 50. And I repeat, when we are equal shareholders, nobody has control. We are only entitled to the profit. You don't consolidate for the books. Nobody has control exists when you have 51% and above. But now in this case, each of them having 50-50, but there was a contractual agreement that H will appoint 60% of the board members, while M will only appoint 40%. So in that case, it is automatic. H will consolidate for L as a subsidiary. So you qualify a company to be a subsidiary if you can appoint majority of the board, even if you don't have control. Control, we know, is at 51, but if you can appoint majority of the board, then that company is deemed to be a subsidiary. So up to that stage, that company has already qualified to be a subsidiary, even if it is 50%, even if it was 30, even if it was 30%, it has already qualified to be a subsidiary because there is a contractual agreement that H will appoint 60% of the board members. Let's proceed. M Limited and H Limited each appoint one member to N Limited senior management team. It is the senior manager appointed by H who makes the key decision regarding to the development of N Limited's new technologies, its principal revenue stream, the market it will operate in, and how it is financed. The fair value of N Limited net assets approximated, that one has no problem. So each of them appoints one manager one member to the senior management personnel. Kila company atoa mtu moja moja. But after giving one, the one appointed by H is the one who will be making key decisions. So if the entity makes key decisions in in the company which has been acquired, then now we overrule the percentage issue. It automatically qualifies to be a subsidiary. So I wanted to make that point clear before even we move. Just remember, we have just started our introduction, but that is a point we had to make clear. So my students, subsidiary will exist even if the parent controls, not even control, owns less than 51, provided that those conditions I've given you there exist. So hapo siku hizi kazi wanachanganisha wanafunzi. Tutafika mahali nawaambia, if it is not 51, tunaacha nje. We don't consolidate. But now these ones will be treated as exemption of cases. Let's go to definition number 3. Definition number 3. Sub-subsidiary. Sub-subsidiary. It is a subsidiary company to one of the subsidiaries within the group. Within the group. So what we are saying, Rubis acquired Canon. You are aware of that? Rubis acquired Canon, but before Rubis acquired Canon, Canon had also acquired Corbil. Remember, some years back, Canon was a petroleum company on its own. Corbil the same, they were different. But Canon acquired Corbil, which made it to be Canon Corbil. Then now Rubis, you know, when Canon acquired Corbil, now Canon is the parent who is making all the decisions. So when Rubis came to negotiate with the parent. They don't negotiate with this one here. So Rubis acquired Canon. Then now Canon was told, come with the people you had also acquired. So in this group, Rubis becomes the parent, Canon becomes the subsidiary. But now in the Rubis group, this one becomes the sub-subsidiary. So from the definition, sub-subsidiary is a subsidiary to one of the subsidiaries within the group. So in this group, Kenol is the subsidiary, but Kobil is a subsidiary of Kenol. So Kobil is a sub-subsidiary. Maybe something which has not been mentioned there, which maybe you can put in a structured way. During consolidation, sub-subsidiary is also treated as a subsidiary. Get that? Assuming this is 90%, then this is 60. This one's an acquired 60. I'm not sure of the percentages. So if Rubis had acquired 90 of Kenol and Kenol had acquired 60 of Kobil, then during consolidation, when we are now doing the group account, Rubis will combine its operations with those of Kenol. Why? Because Kenol is a subsidiary to Rubis. And also, the books of Kobil will no longer be consolidated for by Kenol. They will be consolidated for by Rubis. Once your parent has been acquired, remember the parent of Kobil is Kenol, but Kenol has now been acquired. So once your parent has been acquired, then they cease from consolidating for your books. So the books of Kobil will now be consolidated for by Rubis. But using what percentage? It will be 90% of the 60. It's called arithmetic interest, the indirect control. So they control Kenol they control Kobil via Kenol. So that is 90 of 60, which is likely to give you 54%. So during consolidation, sub-subsidiary, we consider the indirect control. So you take 90% of 60%. That one is well taken care of. Well taken care of. Thank you. We proceed. Associates. It is an investee company in which the parent controls more than 20% of the shareholdings, but not exceeding 49%. That is 20 to 49 of the shareholdings. So a company within the group to which the parent is having between this percentage of shareholding in the group, that is called associates. It is an associate entity. We have joint arrangements. It is an investee company in which the parent company owns 50% of the shareholdings, e.g. a joint venture. So an entity in which the parent has exactly 50, that is called joint arrangements. Examples are joint ventures. Simple investments. It is an investee company in which the parent company owns more than 1% of the shareholdings, but not exceeding 19%. Group. What is the definition of a group? Group consists of the parent company and its subsidiaries. So group is a composition of parent, subsidiaries, by extension, sub-subsidiaries. Associates and joint arrangements are not part of the group. Group consists of parent and the subsidiaries. Non-controlling interest, popularly known as NCI. It represents the portion attributable to the minority shareholders in the subsidiary company. So Rubis acquired 90% of Kenol. So it means 10% in Kenol was not acquired. So the shareholders who owns the remaining 10% are called non-controlling interest, the minority shareholders. So non-controlling is that percentage which remained in the subsidiary, which was not acquired by the parent company. That is okay. So we have a summary table there. So in summary, simple investment 1 to 19, associates 20 to 49, joint arrangements 50%, subsidiaries 51 to 100%. Remember, why I'm giving you that summary table, in examiner might don't tell you this is a subsidiary. You should be guided by those percentages. So at our fingertips, we should know between this to this, because during consolidation, the way we consolidate for subsidiary is not the same way we consolidate for joint arrangements and even associates. We treat them totally, the way we treat them is totally different. So it will be very wrong for us to fail to master the percentages, because if you don't master the percentages, it means you will not know if this is an associate or joint arrangement or a subsidiary. So you just know subsidiary, 51 and above. That one qualifies for consolidation, unless in the exemption of cases which we mentioned. 20 to 49 associates, 50% sharp, joints. 1 to 19 simple. So we don't consolidate for simple, joint, and associates. We only consolidate for subsidiaries and sub-subsidiaries. Another and last definition is goodwill. Goodwill. It is an intangible, non-current asset, which cannot be identified and recognized separately from the entity, since it lacks physical substance. What does that one mean? You cannot have goodwill here and the company there. Goodwill and the company is one and the same. Goodwill and the company is one and the same. For those who are joining now, we are in the handout 22. Goodwill, we are on goodwill. So goodwill and entity cannot be separated. For accounting purposes, goodwill is considered to be the difference between the purchase consideration and the share of net assets acquired in the investee company. Correct. Therefore, goodwill will be the purchase consideration minus share of net assets acquired. So what is this purchase consideration? I've said those who are joining, we are in the handout page 2, under goodwill. That's what we are discussing. So what is this purchase consideration? It is the amount paid stroke payable to acquire the investee. So the amount you are expected to pay to acquire subsidiary, to acquire associates, to acquire joint venture, that amount you are paying is known as purchase consideration. And that purchase consideration can be either in form of cash, shares, and or debentures. Mostly takes those three. It can be in form of cash, shares, and or debentures, those three. So whatever amount you are paying in whichever form is called purchase consideration. Then share of net assets is the portion of equity components acquired. So when we talk of equity, let me break this thing down for you, because goodwill is critical as far as this issue is concerned. So we are saying that goodwill is equals to purchase consideration minus share of net assets acquired. Share of net assets acquired. So for purchase consideration, we have no problem, because we are saying it is the amount you are paying to acquire the company. Payment of which I've said can be in form of shares, cash, or debentures. Then share of net assets. These are the equity components. You know, when you want to buy a company, let's not think, because I know some of us here are, of course, investors. So when you are acquiring a company, how much are you paying? You tell them, fine, let's do valuation of all the assets. Let's do the valuation of all the assets, we subtract liabilities. Please, I'm going to pay you that difference. So a professional valuer will value all the assets, both non-current and current. Then they determine that the assets are 50 million, while liabilities amounted to 10 million. It means the net assets is 40 million. So this person is supposed to pay 40 million. So in case they have charged any amount over and above the net assets, then that is goodwill component. Because ideally, a company should be purchased at the net asset value. Net assets is the total assets minus all the liabilities. But here we are saying, I'm telling you that net assets is the equity components. How does the equity component come here? You know, in your finance, FM, when we talk of net assets, it is assets, the asset minus liabilities. That is in FM. In FM, net asset stands for assets minus liabilities. In accounting, asset minus liabilities is capital, which is what? Equity. So during consolidation, don't go for the valuation. We don't have that time to carry out valuation. So when we go for consolidation, in our questions, which will come later, to get net assets, just check the equity components. When I talk of equity, I'm talking of ordinary share capital, share premium, retained earnings, revaluation, mostly those four. Retained earnings, revaluation, share premium, and ordinary share capital. So what you do, you check on the date of acquisition, how much was the ordinary, share premium, retained earnings, revaluation. You add all of them. Then you realize the total was 80 million. Parent is acquiring what percentage? Is acquiring 90%. So we don't give them the entire equity. We only consider net assets at the percentage acquired. So this is 72. So it means on fair ground at the break-even, no loss, no what, the company should be sold at 72 million. So in case these people will charge us, they come here and tell us, you people pay 90. So if they charge any amount above the equity, then that difference they are charging what? Goodwill. So goodwill will be the difference between what you have paid minus the percentage of equity. Let's concentrate on equity, leave alone the assets minus liabilities. You're only finance, who could go to accounting. In accounting, we focus on equity. This one was just to help us understand why am I saying that net assets is the equity. So we concentrate on equity. Check what was the equity on the date of acquisition. And equity, you check the ordinary, the share premium, the retained earnings, and revaluation reserve. So you check how much was the total, what percentage was acquired. Then at that percentage, that is the value at which the company should be sold. So in case we realize they are charging, the purchase consideration has been quoted higher than the equity we are acquiring, then this difference we are being charged for goodwill. I hope now that is very clear for us. Let's proceed with our handouts. We are in page 2. For anybody who has joined late, we are in page 2. Goodwill. So methods for determining goodwill. We have two methods. And I can assure you 100% that examiner will not tell you which method you are supposed to use in exam. And goodwill is always there because group accounting is there. And in group, there must be acquisition. And when there is acquisition, assessment must be done for goodwill. So goodwill is something which will be there in exam. That one you have to know. But the method of determining goodwill, you will not be told what evil. So it's you to determine, or to decide, whether to use the partial or to use the full goodwill method. So we need to discuss the two, then we see how they are applicable. So partial method. Under this method, only goodwill attributable to the parent company should be taken into consideration. You know, here we have two people. When parent is acquiring a subsidiary, we have the parent and the minority. minority are the NCI, non-controlling interest. So the method will depend. Are you determining goodwill for both parent and minority? Or you are only determining for parent? So where goodwill is only calculated for the parent, then that is called partial method. Where we are determining goodwill for both parent and minority, that is called full method or fair value method. So the next question we'll ask ourselves, how will I know I'm supposed to determine only for the parent? And how will I know I'm supposed to determine for the two of them? That is where the question will come. Illustrated down there. So we proceed to number 2. Full method or the fair value method. This method takes into consideration both the goodwill attributable to the parent and non-controlling interest. I've said that. For the full method to be applicable, either of the following must be in existence. 1, NCI must be stated at fair value on the date of acquisition. All the equity shares of the subsidiary company should be stated at their fair value on the date of acquisition. The second one is not very common. The one which is mostly is the first one. So when minority are stated at market value on the date of acquisition, depend in kidogo. When minority are stated at market value, what does that mean? It means these people, they had an option of selling off. You know, you can be acquired when you are worthless, and you can be acquired when you have market value. So if you have a market value, it means you could have sold to the acquirer, but they decided not to sell. Like in this case, we said the 90 and 10. So minority having 10%, you find this 10 could be sold. Lakini hawakuuza. So to the minority, that is their purchase consideration. That is what they have invested in that company. So if minority in a question whereby the minority are stated at their fair value, then you determine goodwill for both parent and minority. Wao pia wanavaa tai wakisema we also have market value. So we must check goodwill in this company. But where they don't have anything, wao waliambiwa tu wacha tuchukue 90 nyinyi. Hamna kitu lakini wacha tuwawachie hiyo 10. It means they have nothing. They completely have nothing. So they are not entitled to goodwill. But now examiner, what will make the difference between those two methods? Immediately they mention fair value of minority. We calculate goodwill for both. When you calculate goodwill for both, you are applying the full method. In the question whereby hawaongelei mambo ya fair value of NCI, there is nowhere they are mentioning the fair value, then that is partial. So for partial, to know when to use partial, there is no mentioning of fair value anywhere of minority. On date of acquisition, they don't mention fair value of NCI. Then you only compute goodwill for parent. When they mention fair value of NCI, then you use full. Full means calculate for parent, calculate for minority, then you combine the two. Maybe before I even proceed, can somebody repost yapata hiyo their print, the updated past paper, but nazichukua leo ya last sitting. I want last sitting. Can somebody repost for me last sitting question paper in the group? I just want to check what they examined last sitting so that we can be able to see how goodwill was supposed to be calculated. Somebody to do that for me. Just post, or let me ask someone. Brian, can you do that? Just posting that question, the past paper. I want that last sitting one. Though the real question we'll do when we are done with those things. Kindly post in the group so that you can be able to see what I'm telling you. Those are the critical stages of consolidation. Apart from Brian, ukipata wa kwanza just post. Whoever gets first, the first paper, you can just post in the group so that we avoid time. So thank you, Joy has posted. So kindly someone should not post. So I want to check. It was question 1. So let me check exactly what I want. You can rest a bit. I want to check what I want. Yeah. So when you go to question 1 of last sitting, the one which has been shared, I will not read the entire question. The entire question will assume when we are now doing the actual thing. I just want you to go straight to note number 3, additional information number 3. So you are there. They said the group's policy is to measure the non-controlling interest at their proportionate share of net assets in the subsidiary at the date of acquisition. Take that, at the date of acquisition. So what that means, so in that case, we are going to use, what am I saying? Are we going to use full or partial? That not only needs to guide you on which method to use. What do you think? Do we use full or partial? With that not only. Which method is applicable? Wende? Yes, we are going to use the full method. Full. Because proportionate means their share of the net assets. So it qualifies under the number 2 hapo kwa hiyo handout yetu, when the fair value of the subsidiary is stated at fair value. So it means you will add the net assets of the subsidiary, give minority their share. So that is full method. It means you also apportion to the minority. And by extension, though that is not necessary for us, you can check required Roman 2. That is by extension. What was required in that question, Roman 2, down there? Calculate the value of goodwill arising on acquisition. That's why I'm telling you, goodwill is a very key issue in this stage. So they realized students wengi sana wanaogopa mambo ya goodwill. Nowadays, customer wanapenda goodwill computation because people are not interested in that computation. So when it is required, every posting, purchase consideration, ukiweka nini, every posting you make will earn you a mark. So even if goodwill computation is hard, I know it's sometimes challenging as we proceed, just know the steps of calculation. So that even if it is required, if it's required, every entry will be marked. Down there is illustration. So back to our handout. Back to our handout. So in our handout, we have illustration. You have illustration. Health Limited acquired 80% of S Limited on 1st January 2020, paying shillings 120 million in cash. The fair value of NCI on the date of acquisition was 60 million, while the net assets of S were valued at shillings 100 million. Determining the value of goodwill goodwill using partial method and full method. So when using the partial, we say you only calculate for the parent. So you will take the purchase consideration. When it is partial, there is no need for you to write this. When it is partial, you take the purchase consideration, which they say is 120. Then you don't involve the minority. You only concentrate with the parent if it is partial. Then you less the net assets. The net assets acquired, but now, because partial is only of the parent, and the parent never acquired the entire shareholdings in that company, we will take the percentage they acquired. So you take 80% of their 100 million, which gives you 80, meaning goodwill is 40. So when dealing with partial, you don't involve the minority. You don't involve the minority shareholders anywhere. That's what you need to know. And in partial, the net assets must be apportioned. The net assets must be apportioned. In this question, if it was like this, if it was additional information in exam this way, then we use full method. This one, I just want you to know how to separate the two. But if exam was like this, then you use full because minority are already stated at fair value. So in exam, there is no way it can be this way, then you use the two methods. So this one is just help me separate the two of them. Then if it is full, full means bring the parent, the purchase consideration of the parent, which is 120. Then you bring the fair value of noisemakers. Okay, the minority, I like calling them noisemakers because before AGM wanapigana kelele. Unajua watu wakiwa wachache wanajichocha. Leo huyo chairman lazima atoke. They make a lot of noise, lakini ikifika voting watashindwa. So I normally call, ukisikia tunasema noisemakers, those are NCI. So minority were having a value of 60. So we report 180. Then now the net assets, you don't apportion. You don't apportion, please. When using full, you don't apportion this one here. You take them in full. Why? Because when you add parent plus NCI, it is already 100%. Parent is 80-20, so 100%. So when it is full method, there is no apportionment. No apportionment for the net assets. I hope that is clear. Who has a question up to that stage? Who has a question up to that particular stage? Nobody. Nobody has a question. So allow me to proceed down there. Allow me to proceed down there. Deferred consideration and contingent considerations. Deferred imekuwa very common nowadays in your paper. Deferred consideration arises when the purchase consideration is to be paid in future period. Oh yes, it happens. It happens. It happens. You purchase now, then the purchase consideration. You know, like dowry. Dowry is I know maybe ladies or Kasarika, but it's ukiangalia in accounting way, dowry is purchase consideration. Because in fact, they have a direct correlation. You know, dowry mostly is based on the goodwill, and goodwill is determined on the date of acquisition. So sometimes you find the dowry to be paid in future. Sometimes the dowry is paid immediately, even before wedding. It happens in Africa, and Africa is our business. So where the purchase consideration is to be settled in future, that is called deferred. So there is a small disconnect. You pay in future, but the rule of IFRS number 3 is that goodwill is to be determined on the date of acquisition. So it brings a very big challenge, because on the date of acquisition, hata kijana, mimi niliulizwa, sijui kama wengine waliulizwa, unaulizwa umemwona aje, ako aje huyu msichana on the date of acquisition. So when you say, this is God sent, hizo uongo zote, God sent, blah, 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 hizo story, that is now you are recognizing goodwill. That is goodwill recognition. It means huwezi achwa ati enda mkae alafu utatupea feedback. Hapana. You say, are you okay? Yes. That is recognition of goodwill. So goodwill must be recognized on the date of acquisition. Then somebody can decide that I'll pay the purchase consideration in future. So how possible is that? Because to get goodwill, you take the purchase consideration minus the net assets. So if this one is being paid in the future and goodwill is to be determined today, how will you go about everything? We proceed with the notes to get that. Since goodwill is computed on the date of acquisition, the deferred amount should be discounted. Please underline for me the word discounted. That is the main issue. The deferred amount should be discounted to its present value on the date of acquisition. Period. Hizo stories zingine zinakuja sana, not important. That is what I want you to know. When examiner anakuambia ati purchase consideration took place on 1st January 2021, while the amount was to be paid in 2025, then goodwill must be determined in 2021, not when they will pay. You calculate on acquisition. So the best you can do is to discount. Discounting is the determination of present value. So you determine the present value using the formula 1 plus R raised by negative N. So you use the cost of capital. R is the cost of capital of the acquirer, of the parent company. And also, let's take that one keenly. The examiner can give you cost of capital for the parent and subsidiary. So to discount the purchase consideration to present value, you use the cost of capital of the parent company. So R is the cost of capital for the parent company, while N is the duration they will take before payment. So you discount is when you subtract the net assets. So I hope that is very clear with all of us. That is very clear. The difference between the current fair value and the discounted value should be recognized as an expense during consolidation, while the deferred consideration should be recognized as an incurred liability in the statement of financial position. That is true. What you have deferred, the discounted deferred amount, you recognize as a long-term liability. Tick. Then if the current market value is given, if you compare the given current value and the deferred amount, that difference you expense because it's a loss. If you are to buy now, you could have paid 20. Then if you discount the amount, the future amount today, you get maybe 18, then this too is a loss to the group, which should be expensed. So in case the examiner gives you the current market value, then you discount, you get a variation, then that variation between the current market value and the deferred amount is recognized as an expense in the books. While the discounted amount, this 18 which you have discounted, you recognize that one as a liability in the financial statements. Contingent consideration is the amount of consideration which should be paid by the parent company based on the specific conditions. The contingent consideration must be recognized at fair value at the date of acquisition. Contingent means, you know the word contingent itself. In other words, we can say it means subject to. So you're being told if your sales increases by 20%, you will pay us this amount. So there is a slim difference between contingent and deferred, because even contingents are deferred. Actually, all contingents are deferred, but not all deferred are contingent. Deferred, you just defer to pay in future. But contingent, it will be deferred, but based on certain conditions. So for treatment, they're just the same with the deferred. You discount them to present. The only difference is that contingent, that condition attached must materialize. It must happen, is when you consider it. That is the only difference. Accounting treatment for goodwill. So what we have been doing is the calculation. Remember, we are accountants. We are not interested much in the calculation. We are interested on the presentation. Yes, you have calculated, now you have it. Where do you take it in the books? So we read, positive goodwill should be tested for impairment loss and reported as an uncurrent asset, net of impairment in the consolidated statement of financial position. That is true. So positive means the purchase consideration is more than the net assets. So when you take purchase consideration minus net assets, you get a positive figure. Then that positive, you check if the goodwill has been impaired, you subtract impairment, then you take it to non-current assets in the balance sheet. But at this stage, in most instances, though not all, you will be getting negative goodwill. So if you get negative goodwill, this is the treatment. So we go back. However, negative goodwill should not be subjected to an impairment review, rather recognized as income by crediting to the retained earnings account. Negative goodwill means that person paid less than what they are acquiring. Inaitwa bargain purchase price. That is the name we call it. You have bargain. So it is an income. Negative goodwill is treated as income in the books. So if you get negative goodwill, then maybe in note 5, examiner is saying goodwill is to be impaired by 10%. You forget about impairment. We don't impair negative goodwill. Negative goodwill means you paid less than the net asset. So it is an income on your side. You know how to negotiate. That is taken. Key adjustments in group accounting. Easy key adjustment, and the heartbeat of group. That is where the heartbeat of group is. If you understand those 5, you and the group, you are done, whichever group. And to that effect, I'm giving you 3 minutes of break. Then we kick back. Let's meet at 6:44. We start with the key adjustments. Let's meet at 6:44, stretching out, then we proceed. Yeah, break is over. Break is over. So we go to key adjustments in group accounting. And I will say that is the heartbeat of group, where group lies. You get it correct, you are good to go. All right, so number one, we are going to analyze what is called unrealized profit on inventory, which we will be using abbreviation UPI, unrealized profit on inventory. Then we have unrealized profit on sale of fixed assets. We are going to call it UPFA, unrealized profit on sale of fixed assets, UPFA. We are going to check revaluation in the books of the subsidiary. We are going to check something on dividends and intergroup transactions and balances. Allow me to start with unrealized profit on inventory. UPI arises when goods that had been sold, UPI arises when goods that were sold to a group member during the financial period remained unsold at the end of the reporting period. So this is what happens. There is something called transfer pricing. Transfer pricing is the transaction between related parties. Parent and subsidiary are related parties by virtue of being within the same group. So when they transact among themselves, those goods they are selling among themselves, if they are not sold and they are initially been sold at a profit, then that profit is called unrealized profit. So the parent company H, subsidiary S, in the books of H, these goods had a value of 40 million, the cost. Then they sold to their subsidiary at 45 million. It means H is expecting a profit of 5 million. In accounting, profit is realized when the goods have been sold. So among in the individual books, yes, it's a sale, but to the group, you know, group now we bring the two of them together. To the group, the sale should be recognized when S are sold to third parties, non-group members. So when these goods leave the books of S to outside, then the group will recognize a sale, the group as a whole. Though in the individual books of H, yes, a sale is recognized. But to the group, we cannot recognize until the goods are sold. So assuming that by the end of the year, this transaction took place during, at the end of the year, those goods remained. As hawakuuza, venye waliletewa hizo goods zilibaki pale kwa store. They never left. It means to the group, this profit of 5 is unrealized. Unrealized profit on inventory. So it arises when goods that had been sold remained or were held by the other group member at the end of the year. The next question somebody will ask me, what if they sold parts? Part of the 45 was sold, then there is some which remained. So if they sold parts, then unrealized profit you only compute on the remaining, not on the entire consignment, only on the remaining goods in the store. We proceed with our reading. To avoid profit and inventory overstatement, the unrealized profit must be eliminated in full during consolidation. You know how when you are in their profit account, they recognize a profit of 5. You know, profit is recognized when you sell, you have to record in the books. So they recognize an expected profit of 5. This side, in their stock account, they recognize stock worth 45. So if you don't eliminate that 5, it means the profit for the group will be overstated. The stock for the group will also be overstated. So the number 1 is to calculate that unrealized profit. Then number 2, you eliminate it by subtracting. You subtract it from the group profit account. You also subtract it from the group inventory account to avoid overstatement. So we proceed. To avoid profits and inventory overstatement, the unrealized profit must be eliminated in full during consolidation. Down there, UPI is equals to profit margin times the unsold inventory. Profit margin times the unsold inventory. So you just take the profit margin times the goods which remained. They sold 45, but what portion remained? So the portion which remained, if it is all fine, you take the profit margin times the whole amount. If part of it remained, the part which remained is what you multiply with the profit margin. So before I go to however, there is something critical which we have to know. Examiner can tell you that the goods were sold at 20% on selling price. 20% on selling price, or they can say that goods were sold at 20% on cost. So the first one, profit on selling price is margin. Profit on selling price is margin. But if they say the profit is on cost, then this is not margin. This is markup. Profit on cost is markup. And now this one is the one they love most, this second one here. They'll be telling you profit on cost. So don't apply costs, profit on cost when calculating UPI. If they give you profit on cost, you must convert, because profit on cost is markup. So you have to convert the markup into margin, is when you calculate the unrealized profit. So in most questions, the examiner will be giving you markup instead of margin. So you need to know, how do we convert markup into margin? There is a long way process of coming up with that, but we realized a small way of conversion. So I'm not taking you, we are not writing a project here, we just something small, how we convert. So to convert markup to margin, just add the numerator to the denominator, just like that, with the numerator remaining constant. What does that mean? If markup is 20%, you know 20% is 20 over 100. So to convert this to margin, it will be 20 remains, then it is 20 plus 100, which is 20 over 120. That is how we convert to margin. So to convert markup to margin, you add the markup, to the denominator. So if it is 20, it will be 20 over 20 plus 100. If the markup is 5 over 7, if they tell you markup is 5 over 7, then margin will be 5 over 12. You add that to that. So numerator remains constant. If markup is 3 over 10, margin will be 3 over 13. Like that. So in most questions, they'll be telling you, they're giving you the markup. Sometimes they don't even mention markup. They just tell you it was 20% on cost. Any moment they mention cost, that is markup. So convert the markup into margin is when you apply. Let's go to that question for last setting. tuangalie which note is on UPI, because pia inakuanga tu hapo. We check which note is on UPI, then we just calculate that UPI alone. Then we back on what we are doing. So, guided by yourselves, we check which notes. Somebody to tell me which note do you think is talking of the concept we are talking about. Check the additional information. Check the additional information. Which additional information of last setting do you think is talking of this concept we are talking about here? Note 4, note 4, note 4. So let's meet at note 4. Let me open mine. Let's meet at note 4. Note 4 says, on 28th March, H Limited sold goods worth 100 million to S. H to S, parent to subsidiary. H Limited reported a gross profit margin. So it will do a margin direct. So did they have to copy my 20%? 20% from this sale. S Limited had neither received nor recorded these goods in its books of accounts as at 31st March. So if H has not received, those ones are called goods in transit. Those are called goods in transit. I never knew they brought goods in transit here. It's very rare. Those are goods in transit. But the fact remains, there is unrealized profit. Because when the goods left our HQ, head office, kwa parent, inaenda kwa subsidiary, we sold them at a profit. So there was profit expectation. The only issue, it has not been received the other side. So we need to calculate the unrealized profit on goods in transit. So you will take the 20%, so this one has no challenge. You just take 20%, which is 20 over 100, times the whole consignment, because the whole consignment has not reached the other side. So you multiply by 20 over 100 times the 100. Then you get your profit, your unrealized profit to be 20. So the only issue, it is not affecting the stock. You know, I said the unrealized profit affects two accounts. It affects the profit account of the seller, because mwenye ameuza they recognize profit. Then it affects the stock account of the receiver. But now you see the receiver, the intended receiver was to be the subsidiary. So don't interfere with them. So in this case, you will just eliminate it out of the stock. Also, you eliminate it from the receivables account. You have to pata tukifanya someone to hapo mbele. So that should not worry. How to eliminate the goods in transit. So that is it. You know how to calculate. You know how to calculate. Let's proceed. However, elimination of UPI depends with the sales stream. Sales stream. So we have two streams of sale. There is, so this is H, this is S. When H sells to S, this is called downstream sale. So a sale from parent to subsidiary is called downstream. Sale from subsidiary to parent is called upstream. Upstream sale. So the way you are eliminating, the way you will eliminate unrealized profit will depend whether it was down or up, upstream. So in downstream, check here, in downstream, who was the seller? Parent. So minus, you subtract the UPI from their profit account. Profit account is the one we'll be calling the retained earnings. So you subtract from their retained earnings to avoid overstatement. Then in the subsidiary, you subtract it from inventory to avoid overstating their stock account. That is downstream. Back to our notes. So elimination depends with the sales stream. That is downstream sale. This is the sale from the parent to subsidiary company. UPI is eliminated as follows. So you debit retained earnings account, you credit group inventory. You know, a debit to retained earnings is the profit account. A debit to profit is a minus. So I will not even advocate for these words of debit and credit. Simple, minus it from retained earnings, minus from inventory count. That one, students are another issue. The issue comes when it is upstream. You know, upstream, why it brings problem? You know, subsidiary, how many people are there? 2. We have 2 people in the subsidiary. The 2 people in the subsidiary is the parent itself and noisemakers. NCI are also there. In subsidiary, we have parent. Let's say parent was having 80%. So parent is having 80, minority 20. So if there is unrealized profit of the goods which were sold by subsidiary, kila mtu hatabeba msalaba wake. Kila mtu ni nani? Parent and minority. So if the goods are coming from down to up, you take that, the calculation of unrealized will remain the same, regardless of the sales stream. The calculation remains the same. Profit margin times the goods which remain. But now when eliminating, you will take, in the books of the parent will take 80% of the unrealized profit, while minority will take 20% of unrealized profit. To condense down that one, it means if it is upstream sale, the UPI must be shared between parent and minority. While in downstream, you know, parent is the seller. Parent here anakoka peke yake, hakuna watu wengine huko. So no sharing. Downstream, we don't share. We just eliminate from retained earnings from the stock account. But if it is upstream, there is sharing between parent and minority. Please mark that. Nataka tukienda kwa maswali, unaniambia mwalimu, why have we not shared? Hence it was upstream. It will be very okay. So we read upstream. It is the sale from the subsidiary to the parent company. UPI is eliminated as follows. So you debit retained earnings account, in bracket percentage of HCO. HCO, I said, is the holding company. So you multiply the UPI times the percentage of the parent. You also debit minority account with the percentage of minority. Then you credit group inventory account with the full amount. So you eliminate it from parent percentage. You also eliminate it from NCI with their percentage. Then in the stock account, you eliminate everything. In the stock account, I just say so you just subtract the entire amount. So I don't want you to struggle much. What I want you to know are just 2. Computation is the same regardless of the sales stream. That is profit margin times the goods which remain. Then during elimination, it depends. If it is down, just credit retained earnings, credit stock account, period, to eliminate the profit. If it is upstream, you credit for parent with their percentage, you credit minority with their percentage, then stock account, you eliminate the full amount. That one you have mastered. And you know now how it arises. Allow me to go to number 2. Allow me to go to number 2. Allow us to go to number 2. Let's go to number 2. Let's go to number 2. Unrealized profit on sale of fixed assets, UPFA. UPFA arises when an item of PP has been transferred to a group member at a profit. The asset is not meant for resale, and as a result, such profit can't be realized and should therefore be eliminated in full during consolidation as follows. So UPFA, you know what happens? What happens? Parents, tuseme kama Rubis, they can sell. Unajua kuna kitu watu wajui. Unaona hiyo Rubis, unajiuliza side the brand hapo nje unaona Rubis. But to them as a group wanajua, they know this was Kenol, this was Kobil as a company still there. It was not dissolved. Even Kenol was not dissolved. Rubis is even a French company, it's not a Kenyan company. So they know, wakitembea wanajua, hii yenye iko Moi Avenue, this one is Kenol, hii ya Waiyaki, this is Kobil. They know. They know those, ni venye tu Rubis imewekwa kama brand, imepakwa hivyo, you cannot, you as the public, you might not know, but with them, they know. So rubies hata nimeambiwa sahi hawezi fika, they are not even more than 10, they are less than 10. The ones which came up as rubies. But the two, Kenol and COVID, are the ones which are quite many outside there. So rubies can sell a petrol tanker to maybe Kenol. So this tanker had a value of 10 million, then they sell to Kenol at 12 million. The business of Ruby's group is not to sell assets. Their business is to sell petroleum products. And therefore, if they sell this asset to Kenol, it means Kenol is just going to use that to maybe for supplies or something. They are not going to sell it. And since they are not going to sell this petrol tanker, the profit of two will never be realized, because we realize profit upon sale. You know, here what they realize because they have sold to these people. But now when it comes to group, you know, group now cannot what I call combine the rubies. So there is no profit at all because the asset is not meant for resale. So when you sell an asset to another group member, asset of PPE, when you sell PPE to another group member at a profit, then that profit will never. What come as stock? You know, stock we say that we calculate on what has remained in the stock. Here there is nothing like remain, the whole amount, because the asset is not meant for resale. So here when they sold, in their profit account, or they make a profit in their retained earnings. These people in their PP account, they also recognized the asset at 12 million. So these people in their profit account were una two inside the profit account. This side in the PPE, there is 2 excess in the PPE. So if you don't eliminate that profit, it means during consolidation, profit is overstated, also the assets are overstated. You are lying to yourselves. Some of the reasons why people will do that, because you might ask me, then kama wanajua na wako na professional accountant like you, why should they not advise them from the word go not to sell it at a profit, because the profit will not be realized? Why people, you know, people are human beings, let's say we want a facility with banks or any other financial institution. When you want a facility, ukienda kwa bank, the first thing utaambiwa, kindly provide us with your audited financial statements. You're number one. And the audited financial statement and the audited profit account and the statement of financial position. One of the reasons the financials will want to see your financial position is to know, also when it comes to asset, what is your asset base? In case you default, can we recover? Those assets, can we use them as securities? So rubies, and kama kuna watu wa rubies is just an example. Rubies, having known that their balance sheet haiko sawa, they sell amongst themselves very fast. They transfer the other side at a profit. You see, when they transfer a profit this side, the value of the assets are being inflated. So the balance sheet will look favorable. But you see now that is a misleading information. Because why do you inflate amongst yourselves, knowing that that profit will not be realized? But provided they can qualify to get the loan on that basis, who cares at the end of the day? So the inflation can be done with some hidden motives which you might not know. But for us, for accounting, we remove that profit. From PPE, remove it also from profit account. So we are saying there, you debit retained earnings. A debit to retained earnings is a minus, and also you credit PPE. Credit to PPE is also a minus. UPFA is equals to profit margin times the sale value. So to get UPFA, you just take profit margin times the 12 million, the total amount of sales. Because we have said hakuna kitu ati on the remaining. Remaining is only on the stock because stock is being sold. But if it is sale of PPE, the whole amount, you multiply with the whole amount because that asset will not be disposed. So for UPFA, take profit margin times the whole amount. Subtract from PPE, subtract from retained earnings. Down there, before note 3, the concept of excess depreciation stock depreciation overcharge. The concept of excess depreciation So depreciation overcharge. You know what happens? Check here. Check here. Rubis knew very well the cost of this asset is 10 million. With their motives, they sold it at 12 million. Then now consolidation comes. During consolidation, let's assume that depreciation was being charged at the rate of 10% per annum. Let's assume that. So in reality, if they had no motive, this asset was to be transferred at cost, not at a profit. So from the one-go, we were to depreciate. We were supposed to charge depreciation of 1. But because they sold it at a profit, you know, when I sell to you at a profit, Carol, you will depreciate your asset the way you have received it, because your receipt value is your cost. Your receipt value is your cost. So these people will be charging 1.2. So during consolidation, as subsidiary wakileta vitabu zao, wanaleta na depreciation of 1.2. Parents wanajua yenyewe hapo kulikuwa na mchezo. So instead of lying to yourself, you need to do something on depreciation. Otherwise, you'll be messing up. Because you see they are charging in excess of 0.2. Because it was supposed to be on cost, not on profit. So, unajua kuna ile ukweli unadwanga. They have depreciated even profit. But you see, the recipient will depreciate because they are doing a profit. You don't know, you will depreciate the receipt value. Your receipt value is your cost. So these people will end up charging profit inclusive. So depreciation will be excess. That is what we are calling the concept of excess depreciation or depreciation overcharge. So when you charge excess depreciation, there is a serious implication on profits. Remember, depreciation is an expense. Expense is one of the drivers of profits. So if you charge more expenses, the higher the expenses, the lower the profit. So you are understating the profit of the company, of the group. So charge more depreciation, profit is understated, even PPE is understated because you are subtracting more from the assets. So you need to rectify. You need to rectify that by adding it back. So the excess depreciation is a plus. You add it back to profit. You also add it back to PPE. Because initially when you charge the excess, the profit was understated. When you charge more expenses, profit goes down. So profit was understated. Assets were also understated. Just a minute. So you add them back because of the understatement. But now, how will you calculate the excess depreciation? Excess depreciation, you will take the depreciation rates times UPFA. That is how you get the excess. Because UPFA, this 2 is what is bringing the problem. It is what is not supposed to be depreciated. So like in this case, profit is 2. So you just take 2 times the 10% and you get 0.2. So whenever you get in exam the concept of UPFA, 2 workings must be done. Working 1 is to get UPFA. Ile we discuss. You get UPFA first, you subtract it because UPFA is overstating. Remove it from the asset, remove it from profit. Then the second one, you check if the asset was being depreciated. If yes, calculate that excess. So the excess will be based on the UPFA. You know UPFA is the excess amount. So take UPFA times depreciation rate, then add it back. Add it back to profit, add it back to UPA because of the understatement. Back to the notes. This arises when the group charges depreciation on the assets that can be transferred at a profit to another group member. Excess depreciation is equals to UPFA times the depreciation rates That one I've explained. This is how you calculate the excess amount. You take the UPFA times the depreciation rates. The excess depreciation has an effect of reducing the consolidated profit and group PPE. This should therefore be adjusted by adding it back to consolidated profit and group PPE, which I've explained here. So with excess, add it back. So the excess depreciation will be added back to profit, added back to PPE. That story gone. Number 3, revaluation in the books of the subsidiary on the date of acquisition. So revaluation arises due to variation in fair value. Fair value is the market value. Variation in fair value and carrying amount of non-current assets. So whenever there is a difference between fair value and the book value, the difference is revaluation. It can be a surplus or loss. Revaluation should be adjusted for by. So if it's a revaluation gain, you debit group PPE, you credit revaluation reserve. So an asset gain value, you add it back to the assets, then you create account known as revaluation reserve account. Then for revaluation loss is the opposite. You debit revaluation reserve, then you credit the assets. Hiyo wanafunzi wananga shida. Na hiyo revaluation ndio siku hizi wanapenda sana. Nitaangalia last sitting. Concept of depreciation under charge. Concept of depreciation under charge. This arises when there is a revaluation surplus and the group fails to charge depreciation on the surplus amount. Depreciation under charge is calculated by you take the revaluation surplus times the depreciation rates. So what we are saying is this. What we are saying is this one here, which you need to understand properly. In the books, the net book value mostly, it will be called carrying amount. Carrying amount, that is our examiner will be calling it. You have recorded the value of the assets at 200 million. The market value, maybe they have said, is 250 million. It means you have a revaluation surplus of 50. So in the books, you will find the group, they were charging the book value. Whenever you see revaluation, you have to now depreciate the revalued amount. But now what you need to subject to depreciation is the excess amount. That is what they were not depreciating. When they give you the net book value, you know net book value means cost minus depreciation. So they have already charged depreciation. What they have not charged depreciation on is the excess amount of 50. So if you take the revaluation times the depreciation rate, you determine the depreciation which was being undercharged. So how do you adjust for it? When you undercharge depreciation, remember this is an expense. When you undercharge an expense, profit goes up. Right on the check, profit goes up. So how do you rectify that? You subtract. Depreciation on revaluation, you subtract. You subtract it on profit, you subtract it on PPE. That is how it behaves. Because they were not charging it. So profit went up. Subtract PPE, subtract also on the profit. So Brian, so if we have a revaluation loss, we'll deduct the percentage of depreciation. If it's a loss, which is very rare occasions, if the book value goes that way, then we have a revaluation loss of 50. So here you will have excess depreciation. It means it will be treated like a UPFA. It means they were charging excess because they were depreciating to 50 instead of depreciating the 200. So there is nothing big, it's just the opposite of what is required. Brian, I hope you have understood that. So there will be no big issue at all. So back to last sitting. Back to last sitting. Note number 2. Let's go to note 2. Let's go to note number 2. So note 2, note the entire note 2, check note 2 bullet 1. Note 2 bullet 1. Note 2 bullet 1. So in note 2 bullet, no, let me just read the entire note 2. It says, at the time of achieving the controlling interest in S, the fair value of the identifiable net assets approximated their carrying amount with the exemption of the following items. With the exemption of the following items. Bullet 1, an item of plant whose fair value exceeded its carrying amount by 150 million. So that 150 is the revaluation surplus. On 1st April 2009, this item of plant had a remaining economic useful life of 6 years. So when you take 150 divided by 6, you get now the depreciation. So that depreciation toa kwa profit, toa huko kwa PPE. So let me not go to the bullet 2. I've achieved what I wanted. So when we get revaluation, then during consolidation, listen to this. During consolidation, when I'm consolidating for PPE, I will add parent subsidiary plus 150. 150 is the revaluation. So the revaluation surplus, you add that revaluation surplus. Then you minus the depreciation. So depreciation will be the 150 divided by 6. We shall come there. So here imeisha. Let's go to dividends. Let's go to dividends. Dividends, the main concern is on how to account for dividends that were paid by a subsidiary company which was acquired during a financial period. So that's what I must illustrate here. Like this. The year starts on, no, I want to make the illustration instead of me saying then illustration again. Let's do that illustration. Illustration. H Limited acquired 80% of S on 1st October 2020. H Limited declared the first and final dividends of 320 million on 31st December 2020. So this is 31st December 2020. So 1st January 2020. They acquired this company on 1st October 2020. This is when acquisition took place. Both H and S prepares their books on 31st December each year. Required, show how the above dividends should be accounted for by the group. How the dividends should be accounted for. You know what has happened? The subsidiary has been acquired during the year. Now wakalipa dividends at the end. You know, that is very funny. We have a company which we normally declare dividends. So to end up at the end of the year, we can declare dividends of 320 million. And we were acquired during the year. So what will happen? This period from here to here is called pre-acquisition period. That is called pre-acquisition period, while this one is called post-acquisition period. So the question is on how to prorate. Is on how to treat the prorated dividends on pre and post. So one, you need to apportion the dividends for the pre-acquisition period and also in the post-acquisition period. Then how do you treat the two? Remember, this one is coming in the post. Post means after. This one was there before. So the proportionate value, before we go to computation, the proportionate value of dividends in the pre-acquisition period here should be compensated by the parent. Parent needs to compensate. Otherwise, mukiwaacha, After this, watasema sisi ndio wenye kampuni, we are the controlling. Mnakwambia ni watakula hiyo dividends yote. So on the date of acquisition, you have to negotiate with the parent to compensate. So you check the proportionate amount, then they need to compensate. Compensation means in the purchase consideration, which you are going to agree, please factor for those dividends. So the pre-acquisition dividends, this one here, is treated as part of net assets, as part of the equity to be compensated. So in determination of goodwill, when determining goodwill, the proportionate value of dividends is treated as part of net assets. Take that. Then this one here, after acquisition, they will credit to P&L as income. So this one parent will credit as income because they are compensated. So back to the notes. The portion of dividends attributable to the parent on the date of acquisition, that is pre-acquisition dividends, should be credited to the cost of control account. Cost of control account, the way they have to calculate goodwill. The way you are calculating goodwill, that flow is known as cost of control when determining goodwill. I.e., pre-acquisition dividends should be recognized as part of net assets when calculating goodwill. Please note that your students are sometimes proportionate value of dividends in the pre-acquisition period. And this only happens if it was acquired during the year. So the proportionate value of dividends from here to here is recognized as part of net assets when calculating goodwill. So when you are taking the purchase consideration, you want to subtract net assets, the net assets you top up. You know, net asset is the ordinary share premium, retained earnings, revaluation. You also top up the pre-acquisition dividends. Dividends attributable to the parent after acquisition, that is the post-acquisition dividends, should be credited to retained earnings as part of other income. So any dividends which comes after acquisition, that one they will take as income. So initially here. So the computation will be, you debit the dividends receivable account. So dividends receivable, you know, at the end of the day, parent atapata yote, both pre and post, because this one they compensate, that one comes after. So they take 80% of the whole amount of dividends, which was 320. So dividends receivable by the parent is 256 million. Then they will credit cost of control with pre-acquisition. So pre-acquisition, which they will recognize as net assets. Net assets will be 80 times the 320, but at this period, January to 1st October is 9 months. So they prorate at 9/12, which is 192 million. Then they will credit P&L, profit stop loss, with post-acquisition, which will be 80, 320, but from October to December, here is only 3 months. So that is 64 million. So that's how they need to recognize those dividends. So in the dividends receivable account, you consider the whole amount, because at the end of the day, they will receive both pre and post. Then you credit, the one which is more important is this one here, the 192. When calculating goodwill, you remember to add the pre-acquisition dividends. Please, time will come when we'll get to that. So leave it at that stage for now. We go to number 5. We go to number 5. Intergroup transactions and balances. Intergroup transactions such as intergroup sales and purchases should be eliminated in full during consolidation. That is the truth. Anything they sell amongst themselves during consolidation, for example, to get a P&L, then you start with sales. Anything they sold amongst themselves, don't even consider that it was at a profit and a loss. In full, you eliminate. Even intergroup purchases, unatoa. That is the rule. Intergroup balances, on the other hand, arises when the group members owes themselves at the end of the reporting period. So kuna mtu ako na deni ya mwingine. That's what I'm checking what you're saying. Kuna mtu ako na deni ya mwingine. If one has a debt for the other side, you eliminate it from receivable, eliminate from payable. That's what. How are they getting 3/13? That is 13 or 12. Which one? This is 12. I hope this one you're talking about. 3/12. From October to December, so in 3 months. Just what? If that is the case, just what? In the notes. Huyo hawajui kuhesabu months. Ni 12. Just tell you the notes is 3/12. Then you're 13. I will get that done. Get that done. But now for next time, see. So that is over 12. All right. We are proceeding. So I've said when you get intergroup debts, that means parent wako na deni ya subsidiary ama subsidiary wako deni ya parent is allowed, but during consolidation we don't want those stories. Those are your internal affairs. We eliminate during consolidation. If the examiner tells you that there is a group member mwenye alikuwa sijui na deni ya mwingine, you eliminate payables, you eliminate from receivables. Yote. Haya. We proceed with the reading. Such balances should be eliminated by deducting them from group receivables and group payables, the way I've said. So any debts between them, payables, receivable, minus. The current accounts of the parent company and that of the subsidiary company should always indicate similar intergroup balances. They should be the same. What I owe you is what I owe you is what you also recognize as being owed by me. So they should be the same. However, there are instances when these two, it should be this or this, these two accounts may fail to be in agreement. Such instances may include 1, cash in transit, goods in transit, or errors in the books. So if it is cash in transit, it is a plus to cash account. Kama kuna cash in transit, you add it to the cash during consolidation, you subtract receivables because ulikuwa unanidai. So when I've paid, you need to remove it from the debts. So cash in transit is a plus to cash account, is a minus to receivables. Goods in transit is a plus to stock. You add it back to the stock account because goods ikiwa in transit, it means haijafika the other side. So add it back to your side, then that's a mistake. Minus, minus is a minus to receivables, not a plus. Minus. Si ulikuwa umeinvoice customer, unajua invoice customer, when you invoice your customer, when you invoice customers, umeweka kwa receivables, goods hazijafika, customer is not aware. So you add it back to your stock, then you eliminate the receivables. That is how we'll account for it. Errors, it depends. Analytica 23 instead of 32. So that one errors, you treat them as they come. There is no standardized way. So goods in transit plus to inventory minus to receivable. Cash plus to cash minus to receivable. Note, goods in transit should be recognized at the law of cost and net realizable value. So in case you have been given 2 figures for goods in transit, that the cost of the stock was 20 and the selling price was 23, you recognize them in the books at 20, whichever is lower between the two. That's how we recognize stock. Meanwhile, let's go to last setting. Let's go to last setting. Additional information number 5. Let's go to number 5. Additional information number 5. The current account between H and S did not agree, due to the goods that remained in transit. You remember those goods which were in transit. as per note 4 above. As at 31st, the trade receivables of H and H Limited included 600 million due from S. Walipe deni. Yeah, so that is the intergroup balance. So you will subtract those goods in transit and the receivable amount. There is nothing serious. We'll do it when we are doing that question. Let's proceed. There's somewhere we have to reach. Kuna mahali tunafika. Yes, we are almost. So IS 28/IFRS 11, associates and joint arrangements. The objective of IS number 28 is to prescribe the accounting for investment in associates and to set out the requirements for the application of the equity method when accounting for investment in associate and joint ventures. IS number 28 applies to entities that are considered to be associates or joint ventures. Key definitions: associates, it is an entity over which the investor has significant influence. So we said initially when we talked about associates, I only gave you the percentages, which was between 20 to 49. That is associate. An entity where you have 20 to 49, you lack control, you also lack joint control. So where you don't have control, neither do you have joint control, then you have significant influence. You have significant influence. And I want you to go and check indicators of significant influence. Because I'd given you in IS number 24 when we were doing related parties, the indicators of significant influence. So significant influence, it is the power to participate in the financial and operating policy decisions of an investee, but without control or joint control over such policies. I'm saying. So significant influence to participate. So assuming say, which I know some of you maybe you are shareholders of Safaricom. So what wakiwa pale AGM, wanasema ati now the current chairman do what is so and so. How many people are supporting? Munabeba mkono. It means you participate. But on Monday, with the Safaricom ati chairman, you know I'm a shareholder here. I'm not comfortable with your appointment. You don't have control. You don't have control. You only have significant influence. So significant influence means power to participate, but without control. Correct. I hope you have understood. Power to participate, but without control. We have joint arrangements. It is an arrangement in which two or more parties have joint control. What is joint control? It is the contractually agreed sharing of control of an agreement. Types of joint arrangements. I've seen that question being rampant. Types of joint arrangements, we have two of them. We have joint operations and joint ventures, those two. Joint operations is a joint arrangement where the parties have joint control of the arrangement. Is a joint arrangement whereby the parties that have, parties that have joint control of the arrangement have rights to the asset and obligation for liabilities relating to the arrangement. Underline that one. The one have rights to the assets and obligations for liabilities. That's the key one. The parties are known as joint operators. So allow me to build joint ventures so that we see the differences between the two. Joint ventures is a joint arrangement where the parties that have joint control of the arrangement have rights to the net assets of the arrangement. Underline the word net assets. Underline the word net assets. So, you know, net assets is the equity. Some of us here, especially, you know, after Automata Schule, university, college, people are looking for jobs. Then when you secure the first job, people are, I don't know, but people are normally afraid of even staying themselves. After kuoneshana kiburi huko nyumbani that now hautakuwa unaosha vyombo, hautakuwa unatumwa ovyo ovyo, utajikalisha, wacha niende nikuwe na hata hiyo nimesema ni mingi, freedom, inasema kwa freedom. Mpaka watu wanaandika kwa status, freedom is coming soon because kuna job inakuja. Then once they get the job, also they become afraid of staying themselves because they are not sure whether this job will end or not. So they start staying as bachelors, some bachelors in Shepherd. Watu wanakaa wawili. You know, when you say the two of you, that is a joint arrangement. It's a joint arrangement. So in the joint arrangement, kuna ule mtu, and I know one or two of you may experience that. Mnaishi na mtu lakini yeye venye alilipa rent hivi, alishalipa rent hakuna kitu kingine. You know, rent is more of capital part. So yeye akilipa rent, wewe jipange wenye mtakuwa unakula kwa hiyo nyumba. Then there is this other one, ukishalipa rent, wewe ukinunua mboga, yeye anakuja na unga. Wewe ukinunua sabuni, yeye anakuja na nini? Na hiyo nyingine. So if you help each other in all the aspects of the arrangement, then that is a joint operation. So in joint operation, you have rights to all the assets and the obligation for the liabilities. Madeni mnalipa zote pamoja, assets, you will also have equal rights. But there this one here, where you are only entitled to equity, the capital. It means you don't have the assets and liabilities, you don't have equal rights, which is possible, very, very much possible. You can be in a joint arrangement, lakini mwingine anafanya kazi nyingi kushinda mwingine. Very possible. So let's talk of the equity, but not the assets and liabilities. So where they have rights to the assets and liabilities, that is a joint operation. Joint venture, so we speak moja tu, just master one which is easier. Joint venture, they only have rights to equity, the net assets. Master that. IPSAS further classifies joint ventures into 3 categories: jointly controlled entities, jointly controlled assets, and jointly controlled operations. So in government, joint operations is a part of joint ventures, but you prepare to in case of anything. Something which is not written here, which I need to clarify, for accounting, there will be no distinction between joint operations and joint ventures. We account for them the same way. So I'll show you how we account for them. So whether examiner a joint venture, joint arrangement, the joint operations, just account for them the same way. So accounting treatment for associates and joint arrangement. So joint arrangements and associates, they are accounted for the same way. There is no, the way we treat for joint ventures and associates the same. In all of them, there is no control. Control exists when you have 51%. When you lack 51, then you either have joint control or you have significant influence. So joint control and significant influence are accounted for using what we call, they are accounted for using equity method. So the next question will be, what is this equity method? Equity method is a method of accounting whereby the investment is initially, just a minute. So equity method is a method of accounting whereby the investment is initially recognized at cost and adjusted with any post-acquisition reserve in the investee company. This method excludes associates and joint arrangements as part of the companies. We'll add something there. This method excludes associate and joint arrangement as part of the group companies. It should be that way, the word group. As part of the group companies, and therefore, any intergroup transaction and balances should not be, please underline the word not, should not be eliminated during consolidation. Correct. That is hapo ndio tunafika. We don't go to step acquisition. Should not be eliminated during consolidation. So associates and joint arrangements, okay, the rule is this way. You only consolidate for an entity where you have control. So the next question which you need to ask, when do we achieve control? We achieve control at 51%. So when you have 50 and below, then you use equity method. Equity method means, unaona sahi tukiinvest, tuseme tumeinvest Safaricom, tumeweka hata 500,000. Hata kama hata 500 ni mingi. Umeinvest Safaricom 80,000. Hata kama watu watakucheka ati hey, nyinyi ndio minority, ni sawa, lakini pesa yangu ni pesa yangu. So as time goes by, if I invested this in the year 2000, let's say, nikienda Safaricom sasa mimi nataka pesa yangu, you will not tell me that okay, your money is 80. No, it has been growing. So in equity method, you don't consolidate for the operations of the associate, neither do you consolidate for joint ventures. But your investment, you recognize your investment at cost, then you increase. As time goes by, when they declare profits, even if you have 1% in that company, the profit they declare, you are entitled to 1%. So you take 1% times the profits, you increase the 80 as time goes by. But then that 80 plus the profits, you need to recognize in the books. So we only recognize our current investment. Our current investment, the way it is from cost and adjusted with the profit up to date, we bring in the books. Also the profit share, I must take to the profit account. Our profit in that associate we have to take. But any other thing, we ignore. So in the exam, if you get H, S, and A, where A is the associate, S is the subsidiary, H is parent, then A, we cross it out. We don't consolidate for them. There is only one exemption where we consolidate for them. You can have 40, but you appoint majority of the board members. You are the key decision maker. Then in that case, you will consolidate. But without those exemptions, associates and joint arrangements are ignored during consolidation. You only take your current investment, you only consider your profit share, then you ignore any other element. Period. Full stop. So we don't go to step acquisition. Step acquisition ikienda tutakuwa tumeenda kitu kingine tofauti. So we'll stop it at that stage. So what follows is illustration. So right there, illustration. So I'll decide which question. No, I'm going to send you the question we are starting with. I have a certain handout. Your examiner has not been very keen on sub-subsidiary. So there's a question on sub-subsidiary to answer, then we can come to this other one. So I'll share for those who are printing to print in advance. So we are meeting tomorrow. Tomorrow we have a class for 6 hours, divided into 2, 5:30 to 9 in the morning, then 6 p.m. jioni to 9 p.m. So hiyo tutasonga sana, we will really move. Those are our classes for tomorrow. Otherwise, have a nice day. We meet tomorrow, but meeting at 5:30. Today, the turnout at 5:30 was okay. Thank you. We can log out.